Ryan, good morning. So what is a large cap these days? I mean, now we got mega caps. What do you call a large cap?
I think you can comfortably call anything over 100 billion a large cap. Now that we're in the the age where trillion-dollar companies aren't as rare or exist now, we have a whole other range to look at. But generally speaking, we have reduced our large and mega cap holdings, and we do have one of the smallest allocations, probably under 5% in our strategies, allocated to these larger names.
Now, why is that? I mean, these days, ServiceNow, even Airbnb is a hair above 100 billion in this environment. Qualcomm, Intel, et cetera, are all in that category. Even some names that have significant growth, though I know that your concern is that the smaller and medium-sized stocks are going to have a better chance of posting that important growth in the fundamental level in this inflationary environment.
Well, I think when you look at the distinction, growth names, I know with rising interest rates, investors are very cautious with growth names. I think we believe that there should be a distinction between higher growth names and lower, more mature company growth names. So when you look at an Intel or a Qualcomm, these may be GDP plus 3, plus 5% type growers. A lot of the small and mid-cap companies that we favor, they're growing 30 or 40% more a year. So they're more able to overcome, a slight rise in interest rates. When you look at the more mature tech companies, they're really being valued based on current earnings and cash flow yields. So they probably will act more bond-like in terms of seeing a compression in valuation multiples. But we're seeing the better opportunities now, definitely in the smaller cap space.
Yeah, although, you can never be too careful. I mean, a lot of these giants can be creative. Alphabet's a good example today where there's different ad formats. They're going to try to leverage travel and auto on this, reopening post-COVID, which can maybe make up for some tough comps in retail and e-commerce. I wonder, I mean, how much of the names, the large names that you think you may be a little suspect about, which do you favor the most?
Well, it's funny. Actually, Alphabet is kind of the last man standing for us. Alphabet is our only remaining mega cap company that we own, and it's still a small position. But when you look at Alphabet, they're still growing very comfortably over 20% a year. When you look at the margin profile, we believe that Alphabet will have a problem similar to Apple had a few years ago, where, quite frankly, they're generating too much cash. They won't be able to make any sizable acquisitions. The cash is building on the balance sheet very, very quickly. So we think we'll see continued upping of buybacks there. And you combine that with 20% plus growth, that's really the reason why that one still remains in our portfolio.
Ryan, a lot of our guests argue, though, that big tech is the much safer place to be in an uncertain macro environment with rising rates. Some of these smaller names, yes, they are growing, but, the market is trying to figure out whether they're features or platforms. Isn't there more risk when you're going into these names, when you're seeing these valuation compressions and, we don't still know where they're going to settle? Could some of them be washed out?
Of course, there's more risk. I think, as John pointed out, a lot of the tech market has been in a bear market now for about 12 months. And that started with the small, more speculative, expensive names. And then really it was only until January that we saw that kind of reach up to the largest mega cap names and be affected. Our guess is that when we come out of this tech bear market, we'll see those smaller, more expensive names actually outperform initially in the same way that they were the first to get hit roughly 12 months ago. I think, with everything going on in the world, it's very difficult. I think, if we had not seen the geopolitical issues come to fore, I think we'd be in a much better place right now. I'm not sure the market's as afraid of higher interest rates. I think, we need to remember that higher interest rates are indicative of a healthy economy. If we had terminally low interest rates, I'm not so sure that would really get investors comfortable with where the economy stands. So we actually welcome slightly higher interest rates here. And, I think if you look back also in history over time, whether it's the last decade or actually you can look back 60 years. The Wall Street Journal did recently an article on this where they looked at durations and how generally smaller cap companies do better in a rising interest rate environment. And that's because it's indicative of a healthier economy.